What up, boys? Thanks for hopping on this video to watch me rant. In this video, I'm going to go over how cash advance companies, merchant cash advance companies make money, the different layers of making money, so that you can come in from a high level perspective and see the different players and how they work together. So first and foremost, there's going to be, for those of you who don't know who I am, I'm Ryan Chen, founder of Loancator. I manage a brokerage and now credit fund that provides MCA and other commercial financing products. We've been around since 2023, 2022. So stick around and you'll learn exactly how I build my business. And if you like what you see in this video, make sure to subscribe and recommend this to the other people you know inside this financial service world. And let's hop straight into this. So first and foremost, inside the commercial lending world, specifically MCA, there's really four portions that you want to think about. The first is channel. Which basically means how do you get your clients, right? How are you going out there getting your clients? How are you finding them? Whether that's through an ISO arm, meaning you have a bunch of brokerage bringing you deal flow, or you're sending a bunch of emails, you're getting clients funneled to your direct sales team, and you're closing deals from your emails, or you're running pay ads, and you're getting clients to do applications from Facebook or Google Ads. You're getting them to do applications from Google Ads, and then your sales team calls them. It just means how you're getting your clients. Now, there's a million ways to do this, and we're going to touch on each of them. But what worked best for us at Loancator has been emails and brokers bringing us deals. When I say brokers, I don't necessarily mean brokers in the MCA world, because we're also brokers. And what a broker typically likes is to really get control of the entire process. They would rather have their own lenders close their own deals, even if it's slightly worse for the client. The way we got around that was very simple. When we work with MCA brokers, it's because we were offering a different financing program that they didn't have access to. For example, if you're an MCA broker and you had a bunch of MCAs funded toward one client, but you can't get him another MCA, or the MCAs you got approved for it's very, very destructive, then you will bring him to us because of commercial real estate financing. In this example, I brought a value add that he didn't have access to in the past, access to a different form of capital, and that's why he would bring me the deal. So that's what I would do if I was going after other brokers. If I was a broker going after other brokers, I would bring him access to capital he did not have access to before. Because in this world, in this space, really you're bringing two things to the table: access to capital and access to clients. In this example, the broker bringing in the clients, we bring in capital, to a different form of capital that he didn't have access to. So I'm going to go over the specific of each soon, but first I'm going to finish the four layers. Credit underwriting, this is how you decide how to price your deals. This is going to be what you do internally, or what your lenders do to provide an offer. After that, you're going to have access to servicing. This is how you take care of the loan after it's funded. Like think OACH. They're a processor that collects the weekly, daily payments for you. If you're an MCA company, you funded a deal, you have ACH servicing company that's collecting the ACH for you, and that's the servicing side. The last aspect of this is going to be capital markets, which just means how are you getting access to capital. Like, if you're for example, if you're a large company like Capitus, you can actually go ahead and bundle together a bunch of your MCAs and sell it to institutional players through securitization. And what that means is you bundle a bunch of loans, you take it out to an investment bank, they securitize that, and they'll sell it to an institutional buyer. And that's going to allow you to get your money back quickly. That's going to liquidate your position and allow you to deploy your capital more. Capital market just means how you're accessing capital, right? Think warehouse lines, borrowing money at 11% from another fund and you're lending it out to business loans to the business operators, and you're charging 40%. And because of this, you're able to make money through the spread of what you borrow at and what you charge. So that's capital markets. These are the 4 layers. You have channel, you have credit, you have servicing, you have capital markets. So these 4 layers basically makes up the different ways you can make money as an MCA company, as an MCA firm. So most of us get into this space as a broker. So earlier I said that you can get brokers to work with you and send you deal flow that they don't specialize in. For example, like I said earlier, if they're an MCA broker, they typically don't have access to commercial real estate financing. So their clients might be saddled with MCAs and they want to refi the commercial real estate to pay off the existing MCAs so they can come back in with another MCA. But because they don't specialize in CRE, I can use a CRE loan with an MCA broker and vice versa, right? If you have an accountant who specializes in taking care of the client's book, you can give him MCA as additional service to your clients, or a CRE broker, right? Like I said earlier, vice versa. If a CRE broker is your target audience you're speaking to at this given time, you can give him an MCA to his client because he doesn't specialize in that world. And because of the fact that you're working an adjacent sector, not adjacent sector, you're still in the same sector, adjacent service, similar to what you provide, but not exactly the same. You guys can work together and complement each other. And that's how you get independent sales organizations / referrals to work under you, even when you are a broker yourself, right? Obviously, the next aspect of this is when you become a lender. And when you're a lender, it's much easier to maintain that relationship because they know you're direct lending. Some brokers are much more cynical and they want to keep all the monies themselves, brokering their own deal. That's fine. But we early on, I was like that as well. But what I realized is if I continue being cynical and not co-broker deals, I would lose out on deals that would have been closed. I'd much rather make 1% of 100 people's labor than 100% of my labor. And that's leverage. The other channel you can tap into is email. So we talk about the ISO channel here. We use email heavily at LoanCater. 50% of revenue comes from email. And that's because you can get very granular with the way you approach the market. When you're sending emails, it's very much so targeted business owners. You cannot go wrong if you curate your list in advance. If you clean the list in advance and you're sending cold emails to only business owners, chances are you're only going to be talking to business owners. When you're doing paid ads, you kind of have to optimize pixel or the keywords to only get the business owners. And that takes more work, in my opinion, than just getting the correct list to cold email. And it takes more money. That's the harder part. In the beginning, when you don't have pixel optimized, you're going to be getting a bunch of tire kickers and people who are not operators. And so that's why I like email. We run both paid ads and emails, but email by far has been much more profitable for us. The next thing you can do is do a outbound sales team, outbound SDRs. And prior to starting LoanCater, I worked at PMF, right? So pyramid funding. This is a sales floor of over 1,000 sales reps just cold calling, right? They were in charge of the marketing and in charge of the client acquisition. And when I say in charge of marketing, they're not out necessarily doing pay ads or email, but they're taking a cold prospect completely from stage 1 to stage 100, which is the close. And because they're doing that, this is a completely cold outreach approach. I consider that as marketing. Because what is marketing? Marketing is the process in which you take a potential prospect to actual client. And so they're taking the client from stage 0, which is before they even know us. And I consider that marketing. Because again, outbound calls, that's a form of marketing. And so at PMF, everybody was in charge of their own book. Everybody was in charge of developing the relationship and reaching out to prospects that never heard of us in the past. That is what I consider SDR work. Now, I don't necessarily like that. I do not like that as a form of channel because I think it's much more profitable for skilled reps to talk to qualified prospects that are genuinely interested. So we only get warm leads for our reps. We only provide warm leads to our reps. And we have no intention of making a skill rep that I invested in training for, talk to cold leads and turn them into a prospect, because that's a lot of work. I'd much rather get a client in at stage 60 because they already seen our product, they already qualified, they already know what we offer, and have the rep come in between right here. When there's a product market fit and a qualified prospect, have the closer come in here to take them here to the close. Then for them to start all the way here in the beginning. And that's just my perspective, because I don't have a large sales force and I don't have a large office to continuously churn new reps and to continuously bring in new reps to do STR work. To me, that's a lot of headache, and I don't want to do that. And I don't think that's a good way to grow a business, because it's more profitable to get reps to talk to warm leads. Obviously, PMF made it work. A lot of offices I know made it work. Tribeca Group made it work. I personally do not have the capacity to make that work, and therefore I do MDR work, meaning marketing development reps is just another word for reps that talk to warm leads only. So that is why I don't do any SDR work. So that's another channel. And then obviously you also have content, which is this. Like this video right here. I'm making content to what? To get you guys to send me deals, to get you guys to work with us. This is a way for you to attract business as well. And this actually works very well in tangent with paid ads, because what's going to happen is the client's going to see your ad, but they're going to search you up. When they see your content and when they consume your content, you do what's called pre-indoctrination. By the time you guys talk to one of my representatives, you already know Ryan Chen. And if you are talking to my representative after watching my video, it's because you trust me. And that's why content works great with all the other things here. Even broker partners, they will genuinely look to your content as well. So this will feed here. Email will also feed here. And paid ads will definitely feed here. So content is not only a channel you can use to get deal flow directly, but also indirectly feed into your other channels to amplify the ability. So those are the main channels you're going to be looking at. And credit underwriting. Okay, this is a deeper topic. And this is deeper because there's multiple layers and multiple different form of underwriting that's going to be case by case across the board, different by company. But for the sake of this, I'm going to simplify. For the sake of this video, I'm going to simplify different form of underwriting to A, B, and C paper. So A paper, think your Rapid Finance, think your Capitus, think your peers' financials. These are the guys that are going to come in and give you 18-month deals, 12-month deals, 60-month deals on a weekly basis, right? These are the clients that really qualify. They are new to MCAs. They are 700 plus credit. They have a genuinely somewhat profitable business. And these are who you're going to feed your deals to. These are going to be the lenders that are going to best serve the cleaner paper. And behind that, we have your B paper. Think your EBF. Think your NewCo. Think your Capital Assist. Think your Overnight Capital. These are going to be the clients that taking out MCA and they want a second one. And these guys usually cap out at 10 months, sometimes less, 4 months, 9 months. But factor rate for both of these scenarios are similar. They're going to be 130 to 150. And they are both going to be weekly or daily payments. Now, the only difference between A and B paper, generally speaking, is the time duration. The cost of capital are going to be between 1.3 to 1.5. Now, this is broadly speaking. And the difference is, again, the time duration of how much it'll cost, right? It might have the same capital expenditures in terms of payback, but the B paper are always going to be shorter term than the A paper. Now, I will say, what I'm saying is, this is general broad labels. For example, sometimes TVT Capital, which is also another A paper lender, who also falls into B paper, will do bi-weekly or monthly payments. And traditionally, across the board, everyone has only done daily or weekly payments, but sometimes TVT will actually come here and do a monthly payments. So that's where it has slightly out of the box tail events. So that's what I mean by broad generalization. This can be incorrect in certain scenarios, but broadly speaking, this is all incorrect. And then C paper, these are going to be your capital assists, fast funding, and just smaller lenders like Sound Advance, App Funding, lenders that are private money. They're not institutionally backed, and these are going to be like 2 to 6 month terms. Factor rate, again, 135 to 150. What really changes across the board, you'll see as a standard thing, is just the term. The rates might be the same ballpark, but the term itself, the cost of capital stays the same, but the term itself gets shorter and shorter. That's the broad generalization. So that covers credit underwriting. Now, what are the factors they use to determine the term? Well, they're looking at profitability in net income and P&L. They're looking at cash flow and any balance. They're looking at criminal history. So if you use alcoholists or links or anything that checks the merchant's background, you can find out really quickly if they qualify or not. We like to fund 10K deals. At LoanCater, we like to fund clients that are doing 15K, 30K, 100K revenue, 10K to 15K deals. That's our box. We prefer small injections, and we like to do a lot of those injections. So that is our box. If you have clients that have 5 positions and they need a small 10K, we like to do that. If they're a first position deal and they have no MCAs in the past, but they're a restaurant, they have receivables, we like the 10K deals. Most brokers like large deals, and it makes sense because it's a high commission, but we like small deals. That we take care of 10K deals. So you have 10K deals, send to us. I will leave my email address. Actually, I won't leave my email address. I'll leave the support email address in the bottom of this video, and then you guys can send any deals there or apply to our broker platform. And then the next thing is servicing. Servicing as in collecting the payments, right? So we use Go ACH. If a deal goes through, Go ACH collects all the payments for us. There are other vendors you can use, like Stripe. I don't think they actually take financial service companies, so disregard that. But we like Go ACH. These companies are in charge of collecting your payments or even just managing your book after you originate the loan. So you can use different companies to manage that completely. We do it internally. You can have somebody else go ahead and manage all of the collections for you. Deals that go bad, deals that are originated, are profitable, and have them take care of it. Usually it costs maybe 35 bips to manage that entire process, but it's case by case across the vendors. And the capital markets, again, earlier I mentioned Guggenheim Securities. I was at the B2B Finance Expo last week. Guggenheim Securities just performed a securitization for $6 billion worth of MCAs. And that shows a developing market for MCA. That shows how much MCA is growing. That shows how much capital is flowing in this space. This is just how you access your capital. You have different lenders like Base Point providing you capital. If you are a lender with a track record, they will provide you a warehouse line. You have companies doing securitization like Guggenheim Securities, Guggenheim, who will go ahead and sell your book to institutional players, and it'll allow you to liquefy your position so you can do more MCAs. And then you also have your typical family office or friends and family who are going to start you off with your book of lending abilities. If you're new to the space, you typically get your money from your friends and family, and you lend that money, and then eventually you go to Base Point to borrow money because you have a track record to show, and then eventually you get big enough, so you go to Guggenheim, you sell the books to capital markets. And then family offices slash and then institutional funds and then funds. Once you have a track record, you can always put them into a GP LP setup where you become an asset manager for your book of funds. I hope this video has helped. I know the drawing's a little sloppy, but I'm a sloppy guy. Try to be professional. But if you guys have any other question, put it in the comments. I'll add and I'll probably make the next video for any specific questions in the comments. So thanks so much for watching. If you guys have any deals that are falling in the 10K range, again, send it to us. We'll love to fund those. I look forward to working with you gentlemen. Talk soon.